The securities market covers a lot, stocks, bonds, and more. And businesses often use this for investing. There's a lot of stuff in here that you can use for personal reasons, as you may be funding a retirement. I know I have students of many age groups there, probably ranging from 19, and I'm sure there's a couple of them more than 40 in the class. I will be bringing up a few relevant things on a personal note to you. Talking about this young woman here, Melody Hobson, she now has a company. This is like 25 years later, $9 billion in assets. She has a company called Ariel Investments. And securities markets cover a lot of things from stocks, bonds, government loaning, and other things here. It helps businesses find long term funding. You might not get the money from Shark Tank or from an IPO. Well, the IPO is a stock or a GoFundMe page. They could sell securities. And if you do have a company here, you have a small business, and you could do a stock, an IPO. A lot of paperwork, not really difficult. You're going to need somebody with the expertise to do this. And you have a lot of investors. If you're in a pension plan where you work or you are in any funds, such as with Fidelity, they're managing securities and everything, a whole bunch of particles in there. So that way you get better than the 0.25% return you would get from your local bank. Also, institutions do it. If it's a charity, a trust fund, they do that so that the money continues to grow rather than deplete. Stock exchange, you all know what that is. NASDAQ, its other dealers, they're exchanging securities electronically. People buy stocks, they hope it goes up. I'm sure many of you have heard of Apple. If you bought some stocks from them years ago, even a couple of dozen, you might be a millionaire today. And it does help some small companies here with stocks here. Most of them are larger companies there. It does talk about crowdfunding in here. You can raise money that way, and there are advantages and disadvantages here. A lot of this is highly, highly regulated with the SEC, Securities and Exchange Commission, and if you're going to be issuing a stock, they have to receive a prospectus, which is basically information about the company. And if you are going to be buying stocks, you would want to read that to make sure they're viable. It's more than just buying Disney or Apple or Google stock. There's a lot of stocks out there. You have to be careful. It is like gambling. In fact, it is gambling. And if you have stocks, you have shares of ownership in a company. Company has, let's say, 100 shares. You have 25 shares. You own 25% of the company. You have a certificate showing ownership. And some companies do pay dividends. So if you bought a stock for, let's say, $10 and they're giving you 25 cents on each stock and you've got those 10 stocks, you're going to make $2.50 a year. Some of them pay quarterly, some pay annually. The advantages here, this is for the company. You don't have to repay their investment. You go out of business, then you know what, out of luck. You don't have to pay dividends. It can help your balance sheet because it doesn't create debt. So if I do an IPO and I get $100,000, I got these assets there. I don't have to do anything with it. Hopefully, you're going to be performing, so people keep buying stocks. They could trade them. Shows your viability as a future company. Disadvantages. Stockholders have, and this is the advantages also for the stockholder. Um, And you do have that bottom bullet there. Sometimes the management of the company is doing too much to keep the stockholders happy by giving them a dividend, raising the prices, than in actually managing the company successfully. Two types of stock, common and preferred. The preferred are the ones that typically give the dividends. You get the common stock, You buy it because you want it to increase in value, and if you have to sell it someday, I bought it today for $10, I sell it in 10 years for $20, it has doubled in value. Bonds. These are certificates that they're lending money to the firm or the government. A lot of governments depend on revenue from the issuance of bonds. You're building a giant library on the college campus, they're going to issue a bond. This is a state-run community college. They have to pay interest. You want to make the interest competitive, where you're not going to be paying a lot, but you want the investors to be getting a return on their investment. It talks about all these different types of bonds. I have bought some of these in the past. I bought municipal bonds years ago. They were going for like 12%, which was darn good. Plus, they were exempt from state, local, and federal taxes. So this was pure revenue. If I had $1,000, I was making $120 a year on it. This is called passive income. Passive income is when you derive income from what you own. For example, you own a 3-unit apartment building. You have those 3 apartments in there, and that is passive income. You're not out there shoveling the sidewalk to earn money. This is how people get wealthier. They accumulate wealth through passive income, through interest, ownership of real estate because they're renting it. Again, advantages of issuing bonds. If I get them, it is tax deductible for me, and they are a temporary source of funding. You can repay before the maturity date if they are callable. Disadvantages: it increases your debt. You've got to pay the interest. Bondholders can take legal action if they don't pay it. And you've got to pay the face value. So if I have a $100,000 bond and it's due on January 5th, 2028, I better come up with that money. Talks about bond ratings. And it talks about from AAA down to D. The higher the rating, the lower the interest rate. If I were a D-rated municipality or company, I'm going to pay a fortune in interest. Corporations can do unsecured and secured bonds. The secured are covered with collateral, where you have assets such as land, equipment. And you've got special features here: the sinking fund, the callable bonds, and the convertible bonds. And in some of these, they allow you, such as the convertible, you can convert these bonds into shares of common stock. A lot more detail, a lot of detail in here. If you're ever going to invest in these, you really need to know what you're doing. As I said, a lot of companies will be investing some of their cash in these things here because they want to protect their cash flow and their assets. This goes back into other chapters in the text where you've been reading this. If you want to buy stocks or securities, 2 ways. You could go from a human stockbroker, which I have used in the past. They do have their use, or you could go online. If you're going online, you need to know what you're doing. You can become a day trader. That was very popular more than a couple of years ago before one of our recessions, where people would be sitting by their computer all day, clicking and tweaking and making money. Talks here about going up in smoke. This is kind of like, I wouldn't say it's an ethical decision, but if you have a favorite relative die of lung cancer, are you going to invest that money in a tobacco company? Tobacco companies are divesting themselves now because they're going into other areas, because there might be a day when there might be smoking. Other thing too, there are portfolios here where it depends on your personal beliefs or certain beliefs here. The companies only invest in green companies that are clean. They don't invest in coal companies. There's a lot of companies out there. The return on investment may not be as high, but some people go into these types of funds, A, to make this a better world, and B, because they care about the future of the world. Investment criteria. If you're ever going to do this, and this is also if you have a job where you have a 401k. You want to know what the money is going in. One thing I would add, don't put all your money in the company's stock. So if I'm working for Sikorsky, I'm not going to put all my money in that 401k. And in fact, I think it is illegal. You need to have a diversified portfolio, even if you're setting it up on your own. If you're young, you would want to be using things where there's a little bit more risk. It'll grow faster, and if you lose it now, it's not bad. But if you're 59 and want to retire the next couple of years, you're going to have to look at things differently. You have to look at your future. One thing I have heard, that if you want to maintain the lifestyle that you're living in now, you really need about $2 million in your investment for your IRA or 401k. A lot of money. Talks about things here. If you're going to invest, classes, etc. If you're going to get a book, make sure it's copyright within the last year or two. Don't buy something from 1940. It's a lot different now than it was. And there's a lot of articles in magazines. There's Money Magazine, which is excellent. And you can get some online sources, and even the companies such as Fidelity provide very useful materials. And it talks about the average rate of return that you've gotten on an annual basis since 1926, nearly 100 years ago. Company stocks have done good, large company stocks. So it shows you what your annual rate of return has been. You get bad years, you get good years. And it talks about diversifying here. I'm not an investment advisor. I'm doing a presentation based on the textbook, but this is what they're saying. If you're going to go into anything, you want some money liquid. For example, let's say you do inherit $10,000 and you invest it. You want some of the money to be immediately available in case you have to change the tires on your car or you have an emergency purchase to make. And it talks about building your financial future. This is talking on a personal basis. And a lot of this will happen also if you're working, managing a fund for a company. And these are the investment services consumers need. You could see I boldface retirement planning. Very important. If you're young, you got to plan on it now. I don't have a crystal ball. I hope you have Social Security in another 40 or 50 years when you're of retirement age. But I do say have money invested. If you get a raise, what I used to do typically, put half the raise into savings immediately invested. So if I was making $100 this week, I make it 120 next week. I would take $10, half of that raise, put it aside. You're not going to feel it. Other thing you also have to look at as college students, look at what your education expenses are. Look into tuitions, aid. There are loans, scholarships, and they do a lot of things at colleges. A lot of them, especially in the area, want to work with the students. Bull and bear market. You want a bull where you think it's going to rise. And we've had a few bear markets within the past few years. The last one was less than 10 years ago. And we had a huge drop in prices. Things have recuperated quite well. If you sell a stock, let's say I spent $1,000 on some stock, I sell it for $1,200. I had to pay interest on the 200 capital gain. They have stocks according to strategy. You could choose your stocks according to a strategy with these four things here. Some people buy little inexpensive penny stocks. You could also buy income stocks where you know you're going to get a dividend every year. And if you're retired, or even if you have a family, you could use that money to help pay the bills. Stock splits. What it does is, like, when it gets really, how would I say this? Let's say it's up to $100. You can split it. You have two $50 shares. More people can afford it. You're not forced into splitting their stocks. Some stocks have split a number of times over the past few decades. You can buy stocks on margin. Very tough. Know what you're doing. Know how to read these quotations for anything. It shows that, for example, on Microsoft, it opened at 44.88, it closed at 44.95. It shows the range there, the 52-week range. A lot of places you can get this information, such as Yahoo, many Fidelity. Again, I'm sure you can get this on Google. And there's a lot of sites here. As I said, I just mentioned Yahoo, and there's MSN Money, a lot of places to do research. And if you're going to buy bonds, there are questions. Do you have to hold on to the bond till the maturity date? Then there's junk bonds. High default rates, high risk, but high rate of return. You have to decide, if I'm going to spend $2,000 on that junky bond that I'm offering, are you going to survive if you lose that $2,000? You might end up getting a 15% return. These are arbitrary numbers I'm making, versus 4% with something that is safe. Bond quotations, again, know how to read them. More and more people are owning mutual funds. Talks about different investments here with their risk, the income. Those with low risk don't grow as much. You have a mutual fund, medium, variable income. It has a good chance of a return or personal growth. You have to decide what you're comfortable with. Showing the popular firms that were on the original Dow 12. And as you could see, we still have General Electric, okay, and American Tobacco. Some of the company names have changed, but you're seeing how it has changed substantially, and it's gone up to a list of 30. You have the Dow Industrial Average, and it goes into 30 industrial stocks here. They look at that to say what it is. Some people say, which is true, the 30 company Dow, which is what I tend to personally follow, too small. They say follow the S&P 500. They affect the prices of a lot of your investments. Stock market has had ups and downs. Biggest one was last almost 100 years ago on October 1929. We've had a couple here recently within my lifetime, 30 years ago and 20 years ago, when it's losing value. One thing I would say, if you have stocks, don't panic. Let it sit there. It will ride out. It will recuperate. I went through this 20 years ago, and the money came back stronger than ever, or I should say the value. We had a lot of these bubbles here. The dot-com bubble, I remember that. Everybody was investing anything if they had a dot-com after the name. I made a few humorous comments about that. You could have put a .com at the end of your toenail and people would have invested in it. And then in 2008, the real estate market, a lot of problems. We went into a huge panic. Banks went out of business, major decline. It was unemployment. Some of the car manufacturers almost went under. However, Washington, I would say the federal government, stepped in and saved the auto industry, and it came roaring back a few years later. And it's talking to Wall Street of today, and Uber, Subway, it's just comparing things here. Slightly amusing. However, it is a little bit interesting. I wouldn't say people are going to go into Subway for a fancy dinner, but this is what people are investing in, and I do believe Subway is privately held. It's in Milford, Connecticut. And what they do here with the market, a lot of it is automated now. And they're saying this automated caused problems 30 years ago. And they're talking about our economic crises. Wall Street, they did a lot of crazy things here. They were overpaying people. They would get huge bonuses when even they didn't perform. People were living behind their means. This is talking about Main Street. People were taking out equity loans, and there's this concept called being underwater with a house. Let's say you have a house worth $300,000. You got a mortgage for $300,000, and then 10 years later, or a few years later, it's only worth $200,000. It's not even worth paying off the mortgage because you'll never get the money back. People walk away. And what they did here, they were with Washington, they were giving money to people with really bad credit. And they're trying to clean this up. Dodd-Frank, okay? They put a lot of regulations in there, and they're considering getting rid of Dodd-Frank in 2017. And they're talking about hedge funds here. Those could be very, very, what's the word? Awkward, challenging, risky. Bridgewater Associates of Westport is the largest hedge fund in America. I'm sure many of you have heard of it.